How many of you just paid your taxes? And how did that feel? Yes, I know a lot of us would like to pay less taxes. And if you're not maximizing your credits and deductions, you are leaving thousands of dollars on the table. Hi, I'm Dr. Shamim Nazir. I created the Doctor Investor to empower physicians in their investment choices. So today, let's talk about taxes. How can we reduce taxes? People ask me this all the time. I read recently that we pay 97 different types of taxes. That's a lot of taxes. We've got income tax, sales tax, property tax, inheritance tax, gift tax, all sorts of taxes. Robert Kiyosaki says that taxes are often our largest single expense. And Tom Wheelwright explains in his book that in most developed countries, an average person is spending 25 to 35% of their life working to pay taxes. That's about 2 hours every workday and 3 to 4 months every year. So that could add up to a lot of years over a lifetime. And that's why taxes are not just taking our money, they're taking our precious time. They're stealing time from other things we want to do in our life. So reducing taxes is a very important part of wealth building. Because as Wheelwright says in his books, it's not how much you make, it's how much you keep. So let's get into how do most people save on taxes. Well, if you're a W-2 earner, I'm sorry to say there's not a lot of strategies I can offer you because most of that income is taxable. So one of the ways as a W-2 earner you can reduce your taxes is through tax-deferred retirement accounts. Most employers offer a 401k plan, which is a tax-deferred account. So if you have a 401k, IRA, or an HSA, you can put in pre-tax dollars into these investment accounts, and therefore you wouldn't be taxed on that money. So it's money that is taken out before taxes, which is reducing your overall income that you're taking home, and therefore reducing your overall tax liability. Now the key is these are not tax-free accounts, they're tax-deferred accounts. That means you are going to pay income tax on them when you withdraw that money or when you withdraw your returns. And that is going to be taxed at your ordinary income tax level, whatever that is when you withdraw. Now the assumption is mostly that you will have a lower tax bracket when you're retired and therefore you'll be taxed less. But a lot of experts believe that income tax rates will continue to rise and you may be ending up paying a lot more than you expected. And the other thing you have to take into account is inflation. Inflation is rising at 3 to 4% per year. So whatever money you have saved up, you will have less purchasing power from that money than you probably expect to have. And because it's a retirement account, there are some restrictions on when and how you can withdraw that money. And when you do go to withdraw, even if you have other types of income, you have minimum required distributions that you have to take. And of course, you will have to pay taxes on that distribution. But it is a very good way to reduce your overall tax liability if you're a W-2 earner and you don't have a lot of other strategies at your disposal. Another type of investment account that a lot of professionals will have is a Roth IRA or Roth 401k or a 529. This category of investment accounts are considered tax-free. They're not tax-free because you are paying taxes on the money before you invest, but once you've invested, you don't pay tax again. So all the growth that you will have in that account will always be tax-free. So it's another great way to reduce your tax liability overall. So because these are special accounts, they do have certain restrictions. So if you're in a Roth IRA or 401k, you can't withdraw that money before your retirement age. And then also if you have a 529, those accounts are specific for education or other specific investments or first home or other types of things like that. So you have to be aware that there might be certain restrictions to these types of accounts. But if you can take advantage of that tax-free growth, that is also a great way to reduce your overall tax liability over the course of your lifetime. Another type of investment account that you can use to reduce your overall tax liability is a brokerage account. And that appreciation of that investment is of course tax-free, and you will only be taxed if you sell your investments and withdraw the returns. And the key is to make sure that you hold the investment for at least 12 months because then you'll be charged capital gains rate instead of your income tax rate. And usually capital gains tax rate is much lower than your income tax rate. Usually capital gains is around 20%, and some income tax rates can be high as 37%. So if you're in a very high income category, you may want to hold that investment for at least a year so you can avoid paying income tax rate or your ordinary income tax rate and take advantage of the lower capital gains or long-term capital gains. You don't want to take short-term capital gains. You want to take long-term capital gains. So that's another thing you can use to help reduce your overall tax liability on your returns. A very important point to remember, as Tom Wheelwright points out, is that the tax code was written to incentivize entrepreneurs and investors because that activity helps boost the economy, it creates jobs, it builds real estate. All of these things are what the government wants you to do. And that is why the tax code is incentivizing them to do those activities. And they get all the breaks. Real estate is a common thing that people like to refer to for tax savings, but how does it really work? Well, it only helps you for your passive income. It doesn't really help with W-2 or even 1099 income. You can only take passive losses on passive income. So if you have passive income from businesses, other investments, or that real estate, then you can take a lot of deductions from that income and thus reduce your overall tax liability. Now, if you qualify as a real estate professional, that means you spend most of your time doing that real estate activity. You can take it off of your ordinary income. But for most of us who have a regular job and are investing on the side and have some passive income from real estate, it's only going to affect the passive income, the taxes on that passive income, not on our active income. And the way we do that is through something called depreciation, which is a deduction on the property and its components. And you're taking that from the revenue generated by that property, so you're reducing the overall reportable taxable income from that property and therefore reducing your overall tax bill. So that's how depreciation works. It's a great way to reduce the taxes on your passive income and thus keep all that passive income for other uses. Another way to pay less taxes is if you have a business or an LLC, like I have 1099 income that comes through an LLC, and that you can use to itemize all your business expenses, and that could be your travel, your equipment, your car even perhaps. There's lots of ways to itemize those deductions and reduce your overall income from those deductions and thus pay less taxes. So that's how you can also, it's a pain, but you got to keep track of all your expenses and then, take portion of your car expenses, your gas, even your electricity if you work from home, and the space in your home that you use. They have fractional deductions for all of these things. And if you're meticulous and you keep track of all that and report that to your accountant, they can help you take all of those deductions into account and help reduce your overall tax bill. And this is a very interesting difference, as Tom Wheelwright points out in his book, between business owners and employees. Employees pay taxes before their expenses. They get taxed on their overall income and then they go pay for their house, their car, and whatever else they need. Versus business owners first take out their expenses, they pay for all the things in their business, and then they pay taxes on the residual income. So obviously, as you can see, that could make a huge difference in your overall tax liability. So if you're interested in learning more about how to reduce your taxes, I think you should really check out Tom Wheelwright's books. He's got two of them that I've read. One is called Tax-Free Wealth, and the other one is the Win-Win Strategy, or the 7 investments that the government will pay you to make. So he talks about all types of alternative investments that you can utilize to reduce your taxes. So I hope that was helpful. Please let us know in the comments if you have any questions or other topics you'd like to discuss, and let us know your favorite tax strategy.